Joining me in the studio, Luke Smith from Envision Financial. How are you going this week?
Good, mate, yourself?
Yeah, really, really well. We're talking this week about how to transition to a retirement or from a retirement pension fund to fund super contributions. Now, there's a timeline on this, isn't it?
Correct, that's right. Yeah,
Okay.
so it's spot on.
Okay, so how do you do it? How do you start your own pension effectively?
Yeah, so this is quite topical at the moment because 30 June's coming up very quickly and people are thinking about maximising their contributions in a super.
Yep.
So what you can do whilst you're still gainfully employed is approach your superannuation fund, and this is best done where you're over 60 for maximum tax efficiency, but you need to meet your Commonwealth preservation age depending on the year that you're born. So basically, if you're born after 1965, your preservation age is 60. Right. So you're over 60, you call out to your super fund and say, hey, I'd like to start a pension. Now, the rules with this income stream are that you must take between 2% and 10% in the financial year. The reason we're talking about it today is it's a great way of being able to fund a super contribution, as silly as that sounds.
So take money out of super to fund super.
Correct.
Okay. Talk me through that
right,
slowly.
So let's mock up a scenario. We've got $500,000 in our superannuation fund, and we go to the fund provider and say, I'd like to start a transition to retirement pension.
Right.
That means we can take between 2% and 10%. And let's say, for example, you wanted all that money. So we can take $50,000 out of the account. We're over 60, so that means that money's tax-free.
Right.
We might throw some into our mortgage, park it in our offset account, for example. And then we can use some of the money that's come out to put it back into another super fund and claim 100% of that money as a tax deduction.
Okay.
So we're taking tax-free money out of your accumulated super by starting a pension. We're then getting that money in our hot little hand and we're putting that money back into another super fund and claiming 100% of that money going in up to the legislated caps of $27,500 less what you've got from your employer. So some people may have $10,000, $15,000, $20,000 of what we call cap space.
Right.
So that would be the amount that you look to try and get out of your pension to then put it into another super fund and claim 100% of that money as a tax deduction, as if you could have otherwise salary sacrificed through the entire financial year. You get the same tax outcome, but it's just a really good way of giving people a funding mechanism that may not have a lot of spare cash lying around at the moment because the cost of living's gone through the roof and mortgage payments have gone through the roof. So it's a really good way of doing it. And the reason we're talking about it a couple of months out from the 30th of June is obviously there's some paperwork to be completed with your fund, turn it over to a pension, set up all of the accounts and the sort of admin palaver that comes with it. So doing it now gives you plenty of prep time so that in June you can say, right, pay me my 10%, put that back into another super fund, and we'll touch on that in a second.
Yeah, I was going to ask about that.
Yeah. And then you can claim that monies. Now, the reason I say you have to put it into another super fund is under the rules of a pension, once an income stream is commenced with an amount of money, you cannot add to its capital value.
Right.
So it means we take our money out of Fund A, we open up Fund B, and then we put the money straight into another account. And then we tell that super fund, hey, I put in 5, I put in 10, I put in 20. I want to claim a tax deduction for that money. Now, one of the most important parts of the paperwork side of this is you must lodge what's called a notice of intent. And it's a standard ATO form. It can be downloaded from the ATO website, and that gets sent to the fund that you've put the money into.
Right.
The reason you need that is that funds in Australia assume and treat all personal monies as tax-free contributions unless they are informed. And this notice of intent informs the fund of your intention to claim a tax deduction, and they will remit the standard 15% tax to the ATO.
Okay.
And you will get 100% of that deduction in your tax return when you lodge it in July. So you'll reduce your taxable income, the fund will remit the tax that they need, and then you will benefit from the arbitrage between your marginal tax rate at 34 or 39% and that 15% tax rate in super. So it's beneficial from a tax standpoint in a big way.
Okay, couple of questions. The money in Fund B sits there. You can do this annually, can you? And keep contributing to the same Fund B each year
100%.
in a similar way? Okay.
Exactly right.
Okay, and I guess, are there fees attached, extra fees and extra cost attached to running two super funds?
Well, not really, because if you had that same amount of money in Fund A and now you've got 490 in one and 10 in another, from an admin standpoint, it'll be fairly commensurate.
Right.
But the benefit that you would achieve by doing something like this, if we took a $10,000 example, if your marginal tax rate is 39% because you earn over 125 grand, you'll pay $3,900 of tax on that 10 grand.
Yeah.
If you kept it as wages. Put it into super, you pay $1,500. So there's a nice arbitrage there in relation to what you would get, and because your employer doesn't know about it, when you lodge your tax return, your accountant would say, well, they've taxed you on $100,000 here. You've put $10,000 into super. Well, that reduces your taxable income to 90.
Yeah.
So you've had your tax collected throughout the year. You get a bit of a refund. You can then put that back into the fund if you like. You can put it into the offset account of your house. Depends what you have going on.
Gotcha. Okay. So, what should people keep in mind when using that transition to retirement or TTR option?
I think the important thing is the timing and the paperwork. It's not something that happens quickly. A lot of people think that you just turn it into a pension and then the next day you can have your money. Most funds will take some time to be able to facilitate that paperwork.
Right.
Make sure you've got your paperwork correct and do it early. Keep in mind that 30 June is coming and you need to be able to convert your super fund to a pension. You need to then have the pension paid out. You then need to then have the money in the new super fund account, which will need to be open, and the cash must be cleared before 30 June for it to count in this financial year. Right. You don't want to get caught doing it on the 29th of June and have the money land over the weekend, for example, on the 1st of July, which happened a couple of years back where we had some 30 Junes on the weekend.
Year, okay.
Yeah, exactly right.
Okay. Now, just talk to me, for those over 60, you can do all this without actually quitting work, can't you?
That's exactly right. And the purpose of this legislation being created was that the government saw a lot of people leaving the workforce, especially in the defined benefit schemes, where there was a huge amount of professional knowledge, but it wasn't advantageous for people to continue working. So it was better for them financially to leave because of the way that a lot of the defined benefit calculations are undertaken. They created this legislation to be able to say, look, I really like doing my job, I just don't love it 80 hours a week. I'd really love, Mr. Employer, to do 3 or 4 days. And they went, well, we'd love your skill set to stay. Sure. And then the government created this legislation to allow people to effectively take some money out of super without quitting and be able to top up their cash flow for that day of wages that they would have foregone with an income stream. A byproduct of that strategy then allows us to get a little cheeky and a little technical with it and maximise contributions for those that want to use money in their fund that they may not have because they're paying off homes, kids' school fees, whatever else you have going on. This little strategy that we've just talked about is a great way of finding capital to lower your taxable income whilst not leaving the workforce.
Yeah, you're actually talking to one, somebody who's sort of retired. They went, I'm being called back to work. Okay, let's keep working.
Exactly.
I'm with Luke Smith from Envision Financial. We'll have a chat about the book and just some of the time, the deadlines here to get this action happening in a minute. Welcome back, Luke Smith with me, Brian Carlton in the host chair today for Leon, who will be back next week. Luke's from Envision Financial, and we've been talking about the transition to retirement or from retirement pension fund into a super fund contribution, so flipping from one to the other. The deadlines are really important. Let's talk about the timelines. You've got to get this done ASAP.
Exactly.
Start now.
Spot on. And that's exactly why we're sort of bringing it up this far out from 30 June. So you've got to get your existing super fund converted to a pension. Now, there will be paperwork that your fund will require, and there will be pages of information they're going to want to know. Are you over your preservation age? Are you going to take out a pension? How much do you want to take? Where would you like it paid? What's the frequency of the payment? Now, a big misconception here is people hear the word pension, they think fortnightly. In actual fact, a pension is just the act of taking money out in any frequency. So in this instance, we want to make one annual pension payment. As we said before the break, if there's 500,000 in the fund, you could take 50,000 maximum, being 10%. You want one payment of $50,000 paid ASAP because you're going to use it for this, and part of that money will go into another fund.
Right.
So get your fund converted to a pension sooner rather than later.
And you have to inform your fund of all that.
Correct. And they will have specific paperwork that you'll need to attain, complete and return. They may or may not want an original, so check with your fund, because if you need to post it back, which is a little archaic in this day and age, but some still play like that. Again, allow some time. Open up a new fund. Okay, so we need somewhere to put the new capital. So you need to go.
Would that be with the same company you're with now?
It could
Can you do that?
yeah.
Say you're superannuation firm X. Can you start up a second account with them?
You just need to check. Some funds will let you have two accounts. Right. Some funds will let you have a pension and a super fund. Most you can do at the same place. So you can have a pension account and you can have a super fund account. A little workaround here to make it easier is if you had 500,000, let's say you didn't need the full 10%, you could leave 5 or 10 grand in accumulation, so in the fund that you're with, and convert $490,000 to a pension. That way you have a new pension account, but your old super fund still sits there.
Right.
That is, say you haven't opened another one.
If your super fund won't let you do that,
then you can open a new fund.
Go to another fund. Correct. Go to another company.
That's right. You can have a pension with one fund, you can have an accumulation account with another. The benefit here is the act of getting it in over what it's in.
Okay. Now this is separate to that notice of intent you were talking
Correct.
about. Okay,
That's
so
right.
there's one slab of documents you're going to have to fill out, and the notice of intent is another.
Correct, that's right. So we start the pension, that'll be one fund. If you need to open a new super fund somewhere, that'll be different paperwork. So you need to attain that from the fund that you're going to use, bring that to life, and they will tell you how to make the contribution and what they want to do. If it's BPay, if it's EFT, whatever that fund's rules are, you put the money into that account. Once those funds are in, that's when you follow it up with the notice of intent. And that on that form it says, here, this is me, Mr. and Mrs. ABC. Here's the fund that I've sent it to, which is the fund that's receiving the money. On the next page it says, in this financial year, how much did you put in? So that's your contribution amount. Then the next line right under it says, how much of X would you like to claim as a tax deduction? So if you're going to claim all the money, the numbers in those two boxes should match.
Right.
Then you sign it and you send it into the fund that received that money.
Right.
And they will then write back to you and say, hey, Brian, thanks for that. We've recorded that appropriately. We'll remit the tax for you. And your accountant will want to see that confirmation from the fund. That way your tax return and the super fund's tax return, they meet up in ATO heaven and everybody gets their deduction.
How important is it to, and I speak as a sort of layperson here, how important is it to get professional advice when you're doing these sorts of things?
Look, I think mums and dads can do this, and this is why we're sort of making people aware that this is here. It is something that I think most people can do.
Okay.
You just need to be careful of a few things. One, know how much money's coming in from your employer by the 30th of June, because the limit is 27,500. Right. But if you've had 17,500 in employer contributions, you've only got 10 to play with.
Right, okay.
Big mistake here is people go, oh, well, I've got 27,500 from work, I'll do 27,500. It's 27,500 from all sources. From you and any employer, multiple employers, there's one limit.
Right.
Now, an extension of this is, do I have any room in last year's limit or the year before? And we've spoken in previous shows about the catch-up concessional contributions. That could be an extension to this strategy, but for all intensive purposes, let's just worry about this year's. So don't go over your limit. Make sure your account's open nice and early. Make sure your notice of intent follows the cash. If you send the notice to the fund before the money's in, they'll write back and say, sorry, Brian, there's nothing to claim a tax deduction on. Okay. We're not sure why you sent this to us.
Right, so it's a very definite process, isn't
it?
And certain things have to happen in stages before you can complete it.
Spot on, that's right.
Okay.
You've got to sort of tick the boxes here.
All right, so look, one of the best things to do would be to grab a copy of your book.
Run it
off the shelves.
Exactly, it's one of the strategies that's in there. This is called a personal deductible contribution, and it's in the super section under ways to maximise superannuation and also benefit from a tax deduction. And everybody loves a tax deduction. So there's twofold here. Not only are you bolstering your super, potentially with cash that you have, but also you're getting a tax deduction to lower your marginal tax rate, tax expenses, in your tax return that you will lodge in July. So it's the same as salary sacrificing an amount every fortnight through your employer.
Okay.
But if you've come to the end of the financial year and gone, well, I'd rather focus on paying down my mortgage given rising interest rates, I can now take some money out of a pension, or you could pull money out of an offset account, for example, if there's money available to you, add it in under this sort of strategy, maximise your tax deductions, lodge all your paperwork nice and early before 30 June, and then your accountant will be able to get you a few dollars back when you lodge your return in July.
Is there a backlog for these sorts of things? Is it a process to work through?
No,
Do you need to take that into account?
I think, like most super funds, the earlier you can do it, the better.
Yeah.
Because at the end of the day, for a lot of these things, there's probably a human processing something. And
hence the question, it gets really busy at the end of the financial year to process all these.
Most funds are very, very good because they will receive funds. Also, if you are using someone, check and see if there's a deadline. So here's one that people get caught with. Whilst the money must be cleared by 30 June, some funds say, well, we're not taking contributions after the 25th because we can't process them in time. So check with your fund, just ring up and say, look, is there a deadline for contributions this year? Because all funds can be a little bit different and it can get a little hairy leading into 30 June, whether they can or can't get it done, because you don't want to potentially blow up next year or just have them not process it in time, because the funds must be cleared in the account. So it's, whilst it's done electronically, let's allow for a little bit of,
you need some wriggle room.
Exactly right.
Okay.
Exactly.
So where can listeners get more information on that?
So office number 6260-4749. We've got envisionfinancial.com.au on the website. We've got the Strategy Stacker podcast on iTunes and Spotify. We've got TikTok. The handle there is the Strategy Stacker, and we've got Smart Money Strategy out in all good bookstores, as well as Amazon and Booktopia. So it's in there. It's broken down. It's got in there the do's, the don'ts, the when's, the hows. And there's a little something there in English for everybody.
A little present for you for the end of the financial year if you're in that sort of position.
If that floats your boat,
One wouldn't it is the response there.
Exactly right.
Luke Smith from Envision Financial, always a pleasure, always interesting, always learn something. Thanks so much.
Great to see you. Thanks for your time.